Fears of recession, high inflation, and rising interest rates have hindered the US market, European market, and most emerging markets too. However, the Indian equity benchmark indices have outperformed their global peers this year, with the Sensex hitting an all-time high yesterday. The Sensex rose 900 points to a new intraday high of 62,412 points. Now, to gain some perspective on the resilience of the Indian equity market, do see this chart to know how the Indian benchmark indices have outperformed its peers. Now, there were a number of factors that drove Sensex to hit an all-time high yesterday. Now, this was on the back of the latest Fed minutes, which indicated that the rate hike cycle may slow down. While tightening is of course still expected, the anticipation of slow hikes has boosted the sentiment. Now, the decrease in the dollar index and the price of crude oil both contributed to the market's upward trend. Also, the Indian markets have been able to sustain the positive trend backed by better than expected corporate earnings, easing supply constraints in commodity prices, and strong demand across various sectors. Also, I would like to take a moment to highlight the importance of stable domestic inflows in the Indian stock market. The resilience and optimism of India's equity market have defied the pessimism of the world markets. Now, when you consider this in light of India's economic recovery and various economic reforms, the stock market sentiment seems justified. Now, India's macroeconomic figures are still showing progress. Improving industrial output, strong tax collection, solid PMI numbers, and healthy credit growth have all contributed to this strong sentiment. The recent downgrading of India's growth projections by global rating agencies have been making headlines every single day now. Now, earlier in November, Moody's cut its India's GDP growth forecast to 7% from its earlier estimate of 7.7%. Now, this week, Goldman Sachs too slashed GDP growth expectations to 5.9%. Now, this was followed by CRISIL and OECD. Now, we see that a host of banks, rating agencies, and multilateral institutions have recently cut their India's GDP forecast for fiscal year 23. But India is still anticipated to grow between 6 to 7%, even if most of them have reduced their growth projections for fiscal year 23 by a few percentage points. Now, they all agree on one thing though: India will continue to have the world's fastest growth rate in the years to come. That, in our opinion, should serve as our main takeaway as long-term investors. Now, do remember that revisions from such global and domestic agencies will take place because of the macroeconomic conditions we are witnessing right now. However, this does not change the narrative that India's economic revival is on track. While we won't go unscathed due to global challenges, we do believe these are just short-term headwinds that will have a minor impact in the long term. So what does this news mean for you? The resilience in the stock market despite several challenges shows that India indeed has a distinct advantage compared to others. This will have a direct and indirect positive impact on you. Despite the revision, India is expected to retain its tag as one of the fastest growing economies in the world. The underlying fundamentals and growth prospects of India are strong, and the short-term headwinds will have a minor impact on the country's long-term outlook. This will have a direct positive impact and an indirect positive impact on you. While I say this is me, Merlyn Susana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.